Hey guys, welcome to another episode of the Onvisor podcast. My guest this week is Rob Currie. Rob is a portfolio manager with Louisbourg Investments. He's one of the smartest guys I know. He works mostly in the US and international fund teams at Louisbourg. We get into how portfolio managers like himself and his team manage investments, their perspective on investments, the economy, and what's going on in the markets. And it really gives us a in-depth view of how managers like Rob and the team at Louisbourg, or any active manager, really kind of look at the investment world. So I hope you'll enjoy this as much as I did as we dive into the world of active investment management with Rob Currie. All right, Rob, well, welcome to the studio and to the Onvisor podcast. I'm happy you're joining us, man. How are you?
I'm doing well. Thanks for having me. I appreciate the invite.
Good, man. I mean, yeah, you're welcome. We've been actually talking about doing a podcast for quite some time now.
It's true.
From our days at Louisbourg. And yeah, we've done a lot of these, videos or whatever in the past, like the pandemic one where we were over Zoom.
Yeah, in the same building, but in separate rooms, so that we didn't contaminate one another.
Is that how it went down?
Yeah, I think I took the boardroom, the large boardroom, and you were in the small boardroom or something like that. And
yeah, oh man,
trying to make it work.
Yeah, it's we had to make a lot work back in the day. We were the video and the content was very much a bootstrap experience over at Louisbourg, but it's come a long way and it's doing good now. So, Rob, thanks for coming in, and I really just want to pick your brain and have an open conversation about current investment market conditions, the economy, what's going on, trends, etc. So, I think we're going to get into the weeds. I know you like to dig into this stuff a lot. So,
absolutely.
But before we jump into that, man, how have you been? You've been good? Family's good?
Family's good, yeah. Got two little ones that are, wreaking all kind of havoc, but also doing awesome, so that's good.
Sleeping any?
Well, yeah, I mean, honestly, it hasn't been so bad now. I mean, my oldest is 7, and then we got a 3-year-old there too, and they're starting to sleep in a bit more. And, and my 7-year-old, she loves taking care of her sister, so every once in a while she'll even let us sleep in. Every once in a while, it's not very common, but
they can pour the bowl of cereal after a while and all that stuff. Yeah. Okay, sweet. Okay, well, let's jump right into it. So maybe let's just jump right into what's happening in the investment markets and what's kind of setting the tone recently in investment markets. We can talk about stocks or bonds, whichever you'd rather start with.
Yeah, I mean, it's funny because it feels like the best place to start would be kind of the election day in the U.S., November 5th or whatever it was, or around that date, and then kind of what's happened with markets since then.
Sure.
And but one of the things that's always complicated is I spend most of my time in U.S. and international markets, but Canada has obviously become quite topical now as well, and especially with the recent election we've had and stuff like that. So so really it feels like there are a lot of different driving forces. So I'll try to kind of compartmentalize everything and talk about kind of the markets, and then how that relates to like the actual economy happening in that country as well. So if we kind of start with Canada, I mean, obviously this was a very polarizing election in a lot of ways, where the Liberals were kind of with this revamp with Currie coming in, and I think what we're in a place now in Canada where the market is so uniquely positioned because we're a very commodities based economy. So we have oil and gas, which is actually doing okay right now, but there's a lot of conversations about what's happening with OPEC Plus, which are big oil producers that are talking about increasing supply.
Right.
And what will that mean? Well, we're heading into a potential slowdown economically globally with big oil demand from places like China. If that's actually slowing down, what happens to the overall oil market and who's consuming those incremental barrels? And if no one's consuming it, then it puts pressure on prices, which obviously impacts Canada. But then you have other things like banks. Banks are a huge portion of the market in Canada. And if you look at valuations, it feels like they're kind of priced for everything to go okay, right?
Okay.
And so I don't think that anyone would say that they're priced for things to go gangbusters and everything to be great.
Yeah.
But one of the things that banks benefit a lot from is a steeper yield curve, which means that shorter term interest rates are low and longer term interest rates are higher.
Right.
Because they basically get that spread. And right now we have kind of a steeper curve than we've had in the past.
Right.
And so they don't have to give you much for your deposits when you put money in there. They don't have to pay you a lot of interest, but then they're able to charge higher interest.
They got more to work with.
Yeah. So we call those net interest margins. So those are doing healthy. But at the same time, you have provisions for credit losses of if let's say we do go through a tougher time, if the economy continues to slow, that could be basically biting out of that in the back end. So financials are another topical thing right now on kind of how do you position yourself within banks. There's kind of some safe havens in financials, like some insurance companies are, Intact, for example, great business that's at a very high premium multiple, and so that's kind of a typical scenario. Then you also have like things like the rails, where the rails are obviously exposed to a lot of macro moves. So there's really been we could talk about all these different sectors that all have different unique drivers to them, and that's just in Canada alone. But so how we are viewing the market specifically in Canada is we do have some kind of more specific bets, if you will, in terms of if you look at financials, we're less exposed there. We kind of feel like they're kind of priced for perfection in a lot of ways, and we feel like the macro is a little choppy, and so there could be some worsening before there's some incremental improvement. But we're finding lots of names that we like that are more kind of specific and on the ground, and whether it's in the industrial space, we're finding a lot of these unique businesses that are really doing something different that we feel like they have their own kind of idiosyncratic moves. It's not necessarily driven by the macro,
right?
And so we've been putting a lot of time and attention there, been initiating some new positions that we're kind of excited about as well. So, and then we find different parts, like for example, we like CN a bit more than CP, for example, and you have all these different things for rails that make our positioning there in Canada kind of unique.
Yeah.
The U.S. is its own kind of beast on its own because it's so expensive right now, and the market has rallied and kind of stayed higher despite all this.
It's come back quite vividly. Yeah.
Yeah. So I don't want to spend too much time on each market, but in the U.S., we're really dealing with some huge shakeups with the administration in terms of what they're doing with various organizations, and whether you look at what they're doing at the EPA, where they're kind of rescinding some regulations, trying to make things easier to get through and get passed, and permits to get given, but at the same time, making some big changes that a lot of people are not excited about. Reducing regulatory requirements, making things less stringent in terms of environmental regulations. Similarly, with the kind of Medicare and Medicaid, there's a lot of things happening there where they're trying to reduce the spending. So these are big government dollars that are going towards, in Medicare and Medicaid in particular,
right? That
as the kind of healthcare space absorbs that loss of potential revenue, that has ripple effects as well. And then as some people, for example, Medicaid is more of a health insurance in the U.S. for lower income people. So if you have people that are losing coverage because it's becoming more stringent on who's eligible, then obviously that has impacts as well, right? So the U.S. market politically is very complicated right now, but from a stock specific perspective, we're very excited about what we see in some kind of niche sectors. Whether it's like, for example, healthcare, because of all the noise, whether it's NIH funding, which is for like kind of early stage research funding into various therapies and different types of universities that want funding. There's a lot of problems right there where they're trying to cap the indirect expenses of grants that they're giving so that labs don't get as much money. That's putting a lot of pressure on a lot of names in that space. And there's a lot of really nice gems in the healthcare space that we're able to find. So we've been kind of bulking up there, and then similarly, if we look at Europe, it's again a lot more of these niches. We're focusing on finding these businesses that we really like, kind of not necessarily paying attention to. Is Germany really going to bring their defense spending to 3.5% over the next decade of GDP? Is this new government they've elected really going to invest a bunch of infrastructure? We're worrying about that. We're thinking about that, and we're trying to participate, but it's also we're looking at these specific businesses that we really love and focusing there.
Yeah, I love how Louisbourg and your team really does have a formula where you, in some ways, not ignore the noise, but it certainly isn't like your focus. You're focused on the businesses themselves, their sector, how they'll be impacted, and whether or not a certain company has an advantage or a niche or a a foothold in something unique. So I think that plays into your fantastic performance in recent years. So kudos to that, and to you and the
thanks.
team for that. It's been fantastic to watch, for sure. So are there any shifts, and I'm going to talk here like more macro. If you went a little bit more macro, and we were talking to Joe, average investor, right, who's kind of reading headlines, are there any of these headlines, trends, or things that people might come across that investors should be made aware of, whether they're good or bad? So is there anything out there kind of more on a superficial level that you're noticing, talking about?
Well, obviously, artificial intelligence is the what everyone wants to talk about right now.
Yeah, it's big,
and we love talking about it too, because we've spent a lot of time studying that space and feel pretty good about how we're positioned there.
Oh, good.
And one of the things that we've chosen to do is we call it the picks and shovels strategy. There are many different chip designers, NVIDIA being the kind of one that's mostly in the headlines right now.
Yeah, sure.
But pretty much all these companies, with the exception of Intel, don't manufacture their own semiconductors. They have to use this kind of dream team of companies that have put themselves together to create this incredible infrastructure in place to be able to make these things.
Okay.
And we're talking the most advanced type of technology you've ever heard of.
And this is for processing power, correct?
And this is for whether it's GPUs, CPUs, really anything at the leading edge.
Okay, yeah.
So the main company, there's really only one company in the world that can manufacture NVIDIA's chips, and it's TSMC.
Okay.
And this Taiwanese company that it's kind of got a crazy story with how it got started, with Taiwanese government kind of poaching a U.S. A guy that had basically run a lot of different semi-fabs in the U.S., but was kind of overlooked, possibly because of kind of his heritage and being kind of from Asian.
Right.
And in that time period, we're talking a long time ago, that this was just not really necessarily looked at as good. And so Taiwan, made this kind of, we're going to try to kind of come in over the top and bring this guy over here. And really, it's an incredible story of him inventing a whole new business model, because at that time, everyone was making their own semiconductors. And he was very aware, we're not going to catch up on the design, but we can probably run our fabs better than anyone else. And so this was the founding of TSMC, of we're going to become this kind of fringe designer, or fringe manufacturer, sorry.
Right.
And that story has just exploded, and they now are able to manufacture the most advanced semiconductors with the best yields by far, but like way more than anyone else.
Wow.
But that's powered by a lot of machinery that they don't make, that they have to buy. So
right.
you probably have heard of ASML, which is this Dutch company that it's incredible. If you look at these lithography machines that they're able to make, I mean, they if you look at their actual like their most advanced form of lithography machine, they do this crazy thing where they drop this perfect droplet of tin that they hit with a CO2 laser 100,000 times a second, that then creates this crazy wavelengths that then bounce off these ridiculous mirrors that are made by this German company called Carl Zeiss, that then refract onto this thing to print a transistor on this material perfectly. I mean, it's absolutely the most insane thing you've ever heard of in your life.
That's wild.
And there's only one company that makes those lithography machines, and it's ASML.
Okay.
And then there's this incredible German lens company called Carl Zeiss that kind of helps supply them as well. So there's
like
stuff
a team
like that.
effort.
Yeah,
really.
exactly.
Like they all kind of need each other, because it'd be a lot more difficult to have it all under one roof.
Yeah, exactly.
Okay.
And so it's quite incredible. And then there's other pieces of infrastructure as well. Like there's also a company called Integris that makes the most advanced filters. That each molecule matters in this case. So they're going to filter all the material as it gets deposited on at the most advanced level. They're the ones who can kind of produce at that level of purity. And they're also making some of these more advanced chemicals and products that actually go into making it. And they're able to make it so pure. Right. So you need all of these people to be able to make NVIDIA's chips, right?
Yeah,
and
so make it perform where it's expected to perform.
Exactly.
Nowadays,
And people don't really realize that NVIDIA is the goût du jour for today. But and I think they've got an incredible moat, incredible business, and I'm not here to say that they're going to fall off the top here anytime soon. But the stock is very reflective of that, and there is a big risk that a lot of their biggest customers are trying to make their own versions of their chips, right?
Yeah, of course.
And if that happens, there's still only one company that can manufacture them. which is TSMC.
Right.
So we find it's a better way to play artificial intelligence is through the picks and shovels.
Yeah, I mean, that makes a lot of sense. It's, you know, you don't have to go and invest in the actual startup or company who's doing the AI or investing in AI, you know, the Googles, the Metas, the whatever, the big ones. You can do very much an indirect play on AI and what is going to require to keep advancing and get to where we can kind of all nowadays see where it's kind of going, or some people can see where it's kind of going. I think most people still don't even see what it's capable of now, much less where it's going. But yeah, the manufacturer makes sense for sure.
Yeah, and one of the interesting things too is like today there was an announcement that Starbucks is going to start having this green dot assistant, and it's going to be a pilot program for now. But you know, essentially, every retail location they have is going to have this behind the counter AI assistant, where if they've forgotten how to make a drink or it's a drink they've never heard of before, they can ask the AI assistant how to use it. But also, if there's a problem with a machine, like let's say the espresso machine's not working the way they want it to, they can talk to this, you know, and it's a deal with Microsoft's Azure using OpenAI's, you know, ChatGPT kind of API, working together to get this thing going. And you know, you just start to see it's just the tip of the iceberg, right? We're just starting to really start to use this stuff. Yeah. And so the volume that is going to be required. I mean, what's incredible is if you look at the power demand right now, whether it's in the UK, whether it's in Canada, whether it's in the US, like the data center projects that want to get built to be able to supply all this compute that we're going to need. Yeah. It is incredible. Yeah. And oftentimes a doubling of the peak load that a system is used to handling. Right. Which, you know, a lot of people don't know this, but we have not really been, in the US, let's say, for example, there's really been almost no actual power growth in consumption in the US over the past several decades. It's really been, you know, more efficient things being used. Yeah. And what we've been doing is switching off of coal and towards, you know, whether it's natural gas or whether it's more renewables. Yeah. And so there has been, you know, it's becoming more expensive to have power, which is a whole other conversation. But it's not been because power consumption is going up. Yeah. It's funny. I just finished reading my all-time favorite book called Sapiens, and towards the end he talks about where we're at and where we might be going. And, you know, he said, you know, he goes and says, you know, the fact that we're going to run out of energy or whatever consumable is probably not 100% true, because the pace of innovation and efficiency that's coming through is going to eat away at that gap that we perceive, whether it's oil and gas, and because that's actually found out to be renewable more than we thought. And then we're using renewable, and to your point, we're not necessarily even using more and more and more because we're getting more and more and more efficient. So I found that to be very interesting as a general topic, right? Yeah, I think for if we think about you know, what investors should be thinking about, it's hard to kind of parse through certain themes, because what typically happens, let's take power for example. If you look at anyone in the supply chain for power right now, those stocks have ripped. I mean, they're doing phenomenal because everyone knows this. Everyone knows what I just said. Everyone, you know. So if you were to come to me and say, you know, what should I be investing in right now as an individual? You know, it's funny because a lot of people are looking for that type of, you know, the sexy thing right now. Like, what should I invest in? All the time. I remember, like, if you go back to the pandemic, it's like, you know, what should I be investing in right now? Should I be doing, you know, this, like, should I be investing in Zoom, or should I be investing in like this hot thing right now? Yeah. But it's like, that's the funny thing is, like, really, like the harder you have to, the contrarian takes are often the ones that end up doing better, but no one's really thinking about the contrarian takes. Nobody wants to. It's like counterintuitive. We're hardwired to be terrible investors. So it's possible that, you know, at that time that maybe office space, you know, like finding like buying office buildings might have been the best ROI at that time, because everyone thought, who's going back to the office, you know. But no, that's more of a joke than anything. But it is funny that people want to think about what's the theme right now. Where should I be putting my money? And it's like, it doesn't work that way. Because it's what's the theme, but it's also what's already priced in. Yeah, and exactly. Like, I think a lot of people aren't aware of just how aware investors are nowadays. Like, we're talking about supercomputers, supercomputing, AI. Think about this. There are supercomputers out there
who are searching, scavenging all the internet, all the press releases, all the conference calls, everything, and making their own conclusions, doing what you guys do, and what other investors do, and make calls. And so markets are probably as efficient as they've ever been. They probably continue to get as efficient, but that doesn't mean that an investor having a core, a strategy, and a willingness to think outside the box can't succeed. You know what I mean? So yeah, what you should invest in, it really depends on what you believe will happen, or just the long, steady, like, just, you know, things will just keep getting better. Like, just invest in the market as a whole if you want.
Yeah. Well, one of the funny things too is we were getting the most inbound calls on, like, okay, we should be going more conservative. We should be going to cash.
Like from clients.
From clients. Yeah. And just like the overall media sentiment as well, like, was basically at the bottom of the market.
Oh yeah.
So it was kind of funny, and you know, we had put out this release where we were like just reminding everyone about the boom and bust cycle. Mm-hmm. You know, like, the markets go down and then they go back up, and
they always have, always will.
Exactly. Like. And then we didn't purposefully do this, but we just ended up having very good timing on this kind of note that we sent out and put on socials as well, and we're just trying to remind everyone of that, because, you know, the truth is the reason why we don't at Louisbourg do macro investing is because we would be wrong so often.
Yeah.
Because we also felt worried about the market. So it's kind of this weird thing where it's like, yeah, we're worried too. But we've been worried before. We get worried a lot, and we're usually wrong. You know, the market usually keeps going up. So it's one of those things where it's very hard to be right about when I should be in and out of the market.
Oh, market timing, I always, and I'm not sure if I've said this on the podcast before, but I kind of see it as catching a falling knife. You know,
sure.
And not only do you have to do it once before everything starts falling, but you got to do it again to catch when it flips up. If not, you would have been just better off staying. And so there's tons of charts and info out there, you know, about missing the best days and whatever. Mm-hmm. But yeah, you're totally right. Staying invested, generally, for most people, save yourself the headache, pays off. You know, if you believe in your strategy, if you're invested in the right mix, the right assets, or in companies you believe in, then staying true to that, mostly, maybe tweaking here and there, whatever, like on the fringe, but otherwise I think being a long-term investor pays off through and through. Through bust, you know.
Outside of that, like, you're asking about, you know, what are headlines maybe people are missing and maybe we should be paying attention to. It's really all about the macro right now. That's the problem. Is everyone wants to know about what's going to happen with U.S. and China, trade. Yeah. And macro is going to be very determinant. But one of the things that's interesting, if you look at, you know, I said we're a resource-based economy in Canada here. Yeah. We just had a great meeting with a specialist from Calgary on the energy markets, and had lunch with him a couple days ago. And one of the things we were talking about was the export markets for LNG. And you've seen this even in our positioning in our portfolio, we've kind of shifted away from oil, moved a bit more towards pipelines and a bit more towards gas exposure, natural gas exposure. And the reason is because there is a much more compelling export opportunity for natural gas through LNG than there is for oil. That's the kind of the truth of it right now. Yeah. And part of that is because there's a lot of demand in Asia. Mm-hmm. And if you think too, like, there's so much conversation right now in Canada about Energy East and trying to bring Energy East, which I think for political reasons could make sense. I think you could make the argument that there's a need for, you know, if we wanted to participate in sanctions on countries we're importing from, we can't do it if we're kind of beholden to them. Yeah. Or if something were to happen, you know, more militarily, we want to have an integrated system. Yeah, for sure. Here in Canada, so I get that, but there's not necessarily that much of an economical reason to do it. I mean, it might even still be cheaper to import from other countries after we would build an Energy East pipeline, because it's so expensive to build pipelines.
Even after it's built, it could be possible, right?
So it's not necessarily a slam dunk. And whereas if you look on the West Coast, there's such a need for LNG export capacity.
Oh yeah, they're building a big facility in Squamish, I think, right now.
Well, they just finished the first LNG Canada facility is I think receiving its first ships this week or something like that. It's getting pretty close. So
yeah, a friend of mine was working on the project actually.
Yeah. So that's really exciting, and you know, one of the things I find fascinating too, and I'll just say this quickly about energy, is when I was going to university, there was a big divest movement, right, of people worried about climate change and saying, the pension funds and the endowment funds of Mount A shouldn't be holding fossil fuels and
dirty oil, let's say, or whatever.
And I understand the sentiment for sure, but what people don't understand is that supply has nothing to do with demand. Like if you all of a sudden shut down supply of oil and gas in Canada, all that does is create a security issue, because now we're beholden to a bunch of other countries.
100%.
It's a demand problem, not a supply problem.
True.
And so what we should be saying, what I would love to hear from politicians in Canada is, Canada, we want to be the cleanest producers of oil and gas, because a lot of people don't realize there's a lot of water gets used to extract oil and gas, and then a lot of countries just dump that into the environment. It's not very clean, and whereas Canada, we have very strict regulations on how we clean that. There's whole businesses around it. Secure Energy is a company that does that. You can look into them if you're curious. But there's a whole waste management system that goes into oil and gas extraction here in Canada that doesn't always exist in other countries.
True.
And it's like state by state in the U.S. Some states are good, some states aren't. And so if you compare that, what we should be saying is we want to be the cleanest producers of oil and gas, and we want to be the last producers of oil and gas as it kind of moves down, because we want to be the most ethical, and we want to be the cleanest. So from a supply perspective, that's just kind of an interesting way to. I think that's a more nuanced way of viewing it. Where as we kind of move off of fossil fuels, there still needs to be supply from somewheres, and we don't want to be beholden to other supply. We want our own resources, so we have independence that way. I mean, energy independence is a huge flexibility thing. They're finding that in Europe right now, right?
Yeah,
the lack of energy independence.
It's sound policy, I think. Yeah, for sure.
So I just want to remind people of that every time I get a chance to talk about it.
Yeah, good. I like it. Okay, so do you have any thoughts on this? So I saw a chart not long ago about the length of this current business cycle, right? So a business cycle being, from recession or big recession to the next recession, if I overgeneralize here. And if this chart that I saw is correct, which I believe it is, this is like 75% longer than any other economic cycle since World War II. Any thoughts on why that might be or how that works?
Well, so I'm curious what the chart would be, because I guess you'd have to take into account that the pandemic did create a huge stop in economic growth, and there was. So if you kind of exclude that, I can see where they're going from it. But really, what's happened in the West in general has been this kind of increase in government spending.
Right, that's true.
That has caused a lot of that to take place.
Cheap money.
What's interesting is interest rates have been falling. Up until the kind of pandemic inflation era, interest rates were falling for since the 80s essentially.
Oh yeah,
so we've had this. We had Paul Volcker in the U.S. was the chairman of the Federal Reserve, and he was the one kind of taming inflation when it was crazy. People remember interest rates in the 80s, and they were in the teens percentage for a mortgage, right? And
great for bonds.
Yeah, great for bonds. Great for bonds on the way down, and as we've bond returns have definitely been better than they would have otherwise been because of that, kind of going from those teens percentage down to where we were during the pandemic at basically 0%, which is incredible. But that's that brings up the price of bonds for sure. So if we look at that, the cycle has been elongated by things like government spending.
Yes.
There's also been, in the U.S. in particular, less so in Canada, but really good productivity growth as well.
Okay.
I mean, the GDP per capita in the U.S. is almost 90,000, which is incredible. I mean, it's,
wow.
And so that productivity growth has been definitely really good for them. In Canada, because we're more resource based, it's always tricky to look at. There's a big question right now about productivity in Canada, where everyone's kind of asking why have we struggled as much, and it's tough because if you look at what the price of oil was in 2014, heading into 2015 era, like you had this big part of our economy that basically has been struggling for a decade. It's been struggling for a decade,
right?
And it's a big portion of our resources in general have not been great over the past decade. So it's been that puts a big headwind to our productivity growth, because that's kind of a way that's going to dampen the numbers a bit. But you combine that with a lot of bureaucratic policies that have been instituted as well, which create a much slower growth in actual manufacturing and in expansion and construction. You could say that that's actually smoothed the curve a little bit almost. Well, that's one of the reasons why you haven't had a big boom and bust, because it actually takes forever. It takes 7 years to get a big project done, manufactured. Right. If you want to build a new plant, it takes forever. So that could be another thing to explain it. But really, I think it has more to do with, in particular, a lot of people have benefited from selling to the U.S. I'll just talk about trade for 1 second.
Yeah, for sure.
Because globalization has been, it's been incredible. Yeah. But one of the problems the U.S. has had is the U.S. being the global dollar. It means that every year, essentially, the U.S. dollar has been appreciating versus other currencies.
Because of demand overall.
Because of demand overall,
people need it to operate businesses, pretty much.
Yeah. So what's happened with that is that it's pushed, it's made it very difficult for the U.S. to export and very easy for them to import, because imports get cheaper every year.
Oh, yeah.
And exports get more expensive for the receiving country.
Right.
So this has been a huge headwind for the country, but it's also created so in the U.S. you've had massive government fiscal spending that's been happening for a long time. That's been being a GDP growth driver, and then you've had all countries around the world basically selling to the U.S. as well at the same time and benefiting from that.
Big market. Yeah.
Big market. It's the biggest economy in the world, and so that's another reason why you have this problem where the trade deficit has become unsustainable in the U.S. I think that's it's hard for anyone to argue that at this point.
No, yeah.
How you solve that problem, I think we could talk. We could be a bit more nuanced about.
Yeah, I mean that's where that lands. Is definitely more of a question mark. But yeah, I think it is an issue for sure.
So for Canada, I would hate for the rhetoric to fall on we want to decouple completely from the U.S. I think the U.S. is an important trading partner. Trump's here today. He'll be gone tomorrow. This is our closest neighbor. Our biggest ally and our biggest trading partner. Like we have to figure out a way to find independence for sure too, which is one of the reasons why I love the idea of more export markets and building up our ports and infrastructure, building up more capacity to actually get to those ports. Yeah. But that's going to take the country rallying together in Canada, which is
absolutely.
We'll see if Currie can get that to happen, but
yeah, time will tell. But yeah, that's interesting. I guess the stimulus from the government does make sense that it would give that extra push for much longer, than previous cycles for sure. So, you guys are an active management firm, and I definitely still believe in active management. I believe in, both active and passive have their place, even can coexist in a portfolio. But I guess I'm curious to get your thoughts on the value as well as the challenges of active management in today's markets, right? So right now, you're not only dealing and trading against other teams or humans and investors, you're now dealing with bots, algorithms, etc. Can you talk just a little bit about how that's impacting, not necessarily your firm, but maybe your active management as a practice,
Yeah, for us, I mean, obviously we're big believers in active management, or we wouldn't be doing what we do. Yeah. And we've built a really strong track record that kind of proves that we can support our beliefs with actual returns.
Yeah, you're backing it up.
We're backing it up. So, but when you look at the space overall, I mean, I'll give you a great example. So one of the things that I get the privilege to do with my job is I talk with sell-sided, which is, for people who don't know, most banks and then a bunch of other kind of independent investment banks will have a part of their business is they basically consult investors on companies. And so they'll have an individual that covers just banks, and all they do all day is research 15 banks, and they become experts in those banks, and then they call me and they say, here, let me tell you about the sexiest bank right now and why you should invest with them. Right. And they actually get to talk with management a lot more than I do, and they just have really good relationships with. And if you ever listen to an investor a quarterly call, the people who are asking questions, that's what I'm talking about. These are the sell side investors that get special access. Okay,
so they go to the head of the queue, if you will, on the calls.
So I'm talking with these guys all the time, and all the time I'm asking fundamental questions about the businesses that we're looking to invest in or that we own already. Fundamental to their competitive moat, to how the business operates, and they don't know what I'm talking about. Because every conversation they have is about the next quarter.
Right.
results.
I mean, the whole markets are really pegged to quarterly results and quarterly calls. Yeah.
And there was an investment idea that we just wrote up that we ended up not investing in. That I talked with with one of their heads of investor relations, and with that company recently, and I was asking him some questions, and he his whole job is to talk to investors about the story of the try to make it sound exciting and whatever. And I was just trying to ask him basic questions about this is a pretty crowded market. Why does their product stand out? He was like, okay, that's a good question. Everyone's been asking just about the next quarter. I'll have to think about that. And it's like, you have to think about that? Like,
you mean the basics?
This is like, yeah. And you just start to realize that like the entire market is so focused on next quarter.
Yeah, 100%.
And that's just not how we operate.
No.
We couldn't care less about next quarter. I'm worried about 5-10 years from now. That's what I want to know, right?
And that's an edge at the end of the day. If you can allow yourself to look beyond, and if we can all admit that investment's a long-term game, if you can, not ignore, but basically not focus on the next quarter or the short term, I think you have a better chance of success. You mentioned something that I found interesting. You mentioned write-up, and not following through on that write-up. Care to elaborate on that process, how it kind of goes about with?
Yeah, sure, yeah. So we typically, when we invest in a company, we spend, upwards of a month. If it's a very complicated company, it could be even more than that, where one of our researchers will spending the majority of their time basically writing that company up. And whether it's, reading through all their annual reports the past decade plus and listening to the calls, but then also building out financial models. The whole point is basically trying to become an expert in that company and the industry they operate in.
Right.
And what's interesting is a lot of firms will have a lot of research analysts and will focus on being specialists. So you'll have a healthcare specialist, you'll have a technology specialist. We really benefit from being what we call generalists.
Yep.
And we're able to basically see the forest for the trees and understand things at a different level. It's kind of funny because you would think that that maybe an expert would have a better take on a certain name, but I keep talking to this incredibly brilliant PhD guy who's in biochem PhD from University of Toronto and works at an investment bank, and he's calling me all the time, and he's been telling me about these specific biotech stocks that he says are going to be the next best thing. And I just keep asking about the business model, and he keeps saying, well, if it gets approved, it's going to be and of course that's true. And I have made a lot of sound sleeping by not following any of his investment recommendations. They've all been terrible, and he's like one of the smartest people I've ever met. And it just goes to show that like experts sometimes misunderstand kind of where what they should really be focusing on, which is how does the business actually make money?
Yeah.
And is that investable or not?
Yeah. And I think there's something to be said for the curse of knowledge too. If you're too close to something, you're looking at the trees, and every tree looks like an opportunity, as opposed to if you're flying over, you see the big picture, right? Yeah. For sure.
Yeah, I mean, so what we'll do is there'll be some complex companies. I mean, one of the things we say is one of our core tenets is an understandable business. That's what we want to invest in.
Yeah. Yeah, top of the list, right?
But when we say understandable business, we don't mean simple business. And I think that's where sometimes it can get confused.
Right.
So, for example, like I just finished doing a deeper dive into how the regulatory environment is impacting some of our analytical instrument companies like Agilent, for example.
Okay.
Agilent is it's a healthcare company, but it's really it's kind of a more broad base. They make these analytical instruments for analytical labs that are called liquid chromatography, gas chromatography, and mass spectrometry, spectroscopy. These instruments that basically help separate samples. So if you have like a sample that you want to see what's in there, you'll use a liquid chromatography machine to separate all the different elements, and then you'll use a mass spectrometry machine to basically read what they are. And it's this way of analyzing molecules at a very specific level and getting really, really high quality measurements. And they make those instruments. They make the columns that get used to do it. This is complex stuff. I mean. And I can talk about it, and I can sound really smart, but I don't. If I tripped over a mass spectrometry machine, I don't think I'd know what it is.
Totally.
But the way that they make money is very easy to understand because they sell these instruments, they service the instruments because they have wear and tear and they break down. They also sell each time a test gets run. They use these things called a column. It's a consumable that once it's used, it's thrown out, and so they sell the consumables as well.
Right.
So you have a business that sells to labs all around the world. That plays in this competitive space, and they sell this. And so it's not just healthcare. It would also be like there's this thing called PFAS that's kind of making headlines now where It's these forever chemicals that end up finding their way into drinking water and food and stuff like that.
Yeah.
And so it's very hard to measure, because sometimes they can be at a very, very small quantity. And so these machines are able to measure at incredibly specific levels.
Oh, wow.
And so it's been a driver for the business. And there's been some noise with the EPA kind of rolling back some regulations in the new administration. But globally, in general anyways, it's been kind of a growing market for them. And so this is very, very complex stuff, right?
Yeah.
We're talking about high value analytical instruments.
Yeah.
But we know how the business works very, very well,
yeah.
and we feel very confident. Now, if you flip that to a very simple business like mining, we take rock out of the ground and we sell it. It's like very simple.
Highest bidder.
Yeah. But the economics, you don't know how much it's going to cost to build that mine. It's going to take years. You're going to have cost overruns. You don't know what the price of that commodity is going to be when you actually finish the mine. You don't know if there's going to be a hurricane that'll come or some sort of landslide that'll make it inaccessible. Like, there's so many unknowns. So the economics are not simple.
Right.
And so we focus on, when we say understandable business, we really just mean understandable economics.
Yeah, exactly. Yeah.
Yeah.
Can I make sense of it all?
Yeah.
Right. Okay, so let's move into kind of looking down the road. So, at Louisbourg, what are you guys kind of seeing? Is there any way you guys are positioning yourself? We know that the markets have been, volatile at the least lately. Kind of fell off, bounced back, and now it seems to be, a healthier recovery. Still a lot of question marks, but I guess if you guys would have an outlook on markets and the conditions in the market, what would you say that is?
We're kind of a broken record on this because Matt, our VP of equities, I think he was one of the inaugural episodes of the podcast.
First guy.
He likes to say we view things with gray colored glasses. Instead of rose-colored glasses, right? We see things with gray-colored glasses. And so we see the possible upsides, the possible downsides. And in general, though, this is one of the times where we really think active management will stand out.
Right.
There'll be times, if you're going through an up market, for us and for fundamental investors in general, usually what happens is we sell too early. And that's usually how an investor like us would underperform.
Right.
Is we start to think that the growthier names that are getting more expensive in terms of their earnings multiples are all of a sudden unattractive investments, and we sell them, but then they keep going up.
Yeah, they fall out of your model, basically. Yeah.
And so that's kind of the problem that an investor like us would run into. And we've really fought hard against that by finding these businesses that we love and kind of holding on to them. But we also trade a lot as well. Mm-hmm. And so when I say trade, what I mean by that is our portfolio, the names that in our portfolio are very, very consistent from one quarter of 1 year to the next. But the weights at which we hold them can change dramatically. Yeah. Right. So, for example, this note on Agilent, this work I just did on Agilent on the regulatory environment that's impacting from the EPA. This is not should we sell our position or should we double our position? Right. It's this is almost 3% weight for us in our U.S. fund. Is that the appropriate weight, or should it be 1.5, or should it be 4? It's like that's really the conversation we're having. But then the stock could move and it could make the decision for us. If the stock's up 10% tomorrow, we're selling. We're not selling all of it. Yeah. But we're bringing our weight down because the risk reward is now not as favorable.
Exactly.
Right.
At least for that period of time.
Exactly. Yeah. And then if it falls back 10%, we buy it back. And so that actually creates a lot of value for us. So we view the market with these kind of gray-colored glasses, and we end up being we usually outperform in down markets and underperform on up markets. But lately, actually, that script is kind of flipped, where we're actually kind of outperforming on both, which has been nice.
Yeah, it's really nice.
But if you look over a long track record, that's kind of probably more likely what's going to happen. So in markets like this, where things are quite choppy, we'll often be positioned more defensively. But what I'll say with that is that there are so many pockets that we're kind of excited about that kind of change that narrative, that we're kind of willing to take some cyclical names and wear them just because we find that the market's underappreciating them so much.
Right.
So yeah, we're kind of looking at it both ways, but that's what I mean, where it's the market overall. It's like try to make a call on the market overall. It's going to be very difficult because there's so many moving pieces. Yeah. But what do I think of the risk reward right now with United Rentals? Which is a very cyclical name. We're talking about renting and equipment to construction companies for the most part. it's I can look at that business, look at what they're priced at, and make a reasonable call about what the risk reward is. That doesn't mean I'll be right 100% of the time.
No.
But overall, with the portfolio, we're right more than we're wrong on that risk reward analysis.
Right. Yeah, because you have different ingredients. You have the price of the share, the outlook of the economy. So you can kind of go and assess, and then a lot about the business itself. So you have more than one place to pull from, including your own experience with the company and your own relationship with the stock, to make an assessment kind of more for that particular company as opposed to the market as a whole.
Yeah, and Daniel Robichaud, our head of U.S. and international equities, can't say enough about how much I love working with this guy and working for this guy. He's just an incredible mind, incredible investor.
Yeah,
so
great guy.
I feel very privileged to work with him. I think he's got the right attitude for this market as well.
Yeah.
And then same with Matt. Mathieu Roy, our VP of Equities, who is just a phenomenal. He's been a Canadian investor for so long now.
Yeah.
That he just knows the market inside and out. And then we have Heather with our fixed income, who's just been really killing it too. So we've got a group of really strong performers and a great research team.
Yeah.
So again, like I always kind of sound like a broken record when it's asked, like, what's your view of the market? It's like, your bet's as good as mine. But that company, I bet you I'll be right more than I'm wrong about our list of companies.
And I think that's the best answer I could hear from an active manager is, listen, I don't not hear the noise of the macro and the economy and the big picture, but I'm focused on what I have and how I'm going to manage it. So, I think, you guys are doing a great job what you're doing, which is managing these baskets of stocks in each fund. And I find it absolutely fascinating and phenomenal that you guys are doing it right here in Moncton with a great team, awesome local story. Keep doing what you guys are doing.
Yeah, we definitely don't fall into the group think. There's no Toronto bar or Wall Street bar that we're walking into and getting the same idea from everyone. We're independent thinkers, which is honestly, I think, has served us quite well.
Yeah, a lot of active share with you guys, which is, if you're going to be paying a team to manage your money, you don't want your portfolio to look like the S&P or TSX. You're not paying you're not getting what you're paying for, basically. But with active share similar to yours, I think you can be very proud of what you guys are doing. So I think that's it for today. Thanks a lot for joining us today. Hopefully we'll do this again down the road. And till next time, guys. Cheers.